Welcome back to Closing Day. I'm Jeff Delgrand, your host, and today I have with me Sean Russell from Home Equity Bank, and we're talking about reverse mortgages. Sean, we touched on a couple of topics in the first half of the show, but something I needed to ask and I forgot was, what if someone has bad credit? Are they going to qualify?
The short answer is yes, and I'll expand on that for you.
Okay, please do.
We don't decline individuals based on past credit woes or consumer proposals or past bankruptcies. We're going to work with everybody.
Right.
The only difference is they might receive less loan to value or less money than they would normally qualify for based on that circumstance. But we certainly will work with them.
All right, so like for example, if someone were to come to see me because they've got debt and they're trying to clean it up, odds are, if they're coming to see me, they're really in debt and they've messed their credit up. So they could use a reverse mortgage to pay this debt off and to start to build their credit again?
They certainly can, and we see that very often.
Okay.
With our applications, we do require a credit bureau to be attached to that.
Yeah.
But again, we're not declining a file or approving a file based on that credit bureau. We're just looking at it because in some instances we do need income verification for the individuals, but we're certainly going to work with them through any difficult situation they have, and they can use the funds from the reverse mortgage to help their situation out.
Wow, that's great because debt, financial stress is probably one of the biggest stresses that people have.
100%.
And this gives them a solution to a problem. So
it does. And just to further to that, we talked about the reasons why people use reverse mortgage earlier, and they're not isolated. So what we often find is many of the people we work with have a little bit of debt that they want to pay off or need to pay off, but they also have other reasons as well. So they're sort of doing one and two or three things all together, and it just makes for a wonderful experience when they're all said and done.
That would be nice. Yeah, so they could potentially get a reverse mortgage to take care of debt, maybe help out a son, daughter, or a grandchild with a down payment on a home, and maybe have a portion of it for a monthly income.
All of the above. And I worked with a wonderful woman last year. She did a reverse mortgage, and she had to do a few of those things. She had to pay off some debt.
Yeah.
She needed to put a new roof on her home. She helped out some family, and she took a cruise in December of that year with her bridge club friends that she couldn't do for the previous 5 years given her circumstances. So she called me at the funding of the deal, thrilled that she was able to take this cruise with her friends.
Yeah, that's got to be rewarding, being able to help people out like that.
Very nice. It is very nice.
That's great. Well, you feel like Santa Claus 365 days of the year.
There you go, yes.
Now, the other thing I was thinking, the question that comes up is, there's a mortgage product. It's called a HELOC. I won't get too detailed, but basically it's part mortgage, part line of credit that people have on a house. How does that differ from a reverse mortgage?
Great question. We get this often. So HELOCs are offered by the traditional banks typically, is where you find those products. And it's just home equity line of credit.
Yes.
The main differentiator between those two products is that at the bank, to get a HELOC, you need to go through some income qualifications. Number one, which we don't need to do. So oftentimes, the seniors that we're working with won't qualify for a HELOC because of their age or lack of income, various factors, and the banks are very stringent on what they're looking for. So they might not qualify. Number two, if they do qualify, you are required to make the monthly only minimum interest payments. With our product, there are no payments required. So from a cash flow perspective, our product's very helpful for seniors that don't have the cash flow to make payments, and they don't have to qualify from the income standpoint that they would for a HELOC.
Okay. Now, that's great, especially because if they have to make payments, if they're coming to us to get a reverse mortgage to get out of debt, and then they have to start making payments again, that just...
Well, it's troubling. And one other factor between those two products, between our reverse mortgage and the home equity line of credit, is that the HELOCs are callable, which means that at any point in time, the bank could call a client and say, we feel that we need to close down this facility, we need you to pay it back, and we're going to close it down. Now, you can imagine, if that was a $100,000 line of credit, most people would have to sell their home to pay that back. You're never going to have that fear with our product because our product is not callable. You'll never get that phone call that says you have to pay us back. So that's another big difference.
Wow, that's wonderful. Now, if someone's taking out a reverse mortgage, whether it's a lump sum or monthly payments, how's that going to affect their CPP or their income tax? I mean, I don't want to get us into this big quagmire of taxation stuff, but how's
It's a simple answer. It doesn't.
It doesn't.
It does not. It will not affect their pension income whatsoever. This is a client is simply accessing the equity from their principal residence. So there are no tax implications for one. It is tax-free dollars because the equity from your principal residence, and it will not affect in any way your pension income.
Really?
Correct.
That's ideal. Now, let's talk about the inevitable. What happens when someone passes away?
Correct. So I don't know the percentage, but in a large number of our clients, we get paid back when they pass away. You got to remember, Jeff, we're dealing with individuals that have said to us early in the process, we want a solution that lets us stay in our home. We're not dealing with individuals that want to sell their home. If they wanted to sell, they'd sell their home. So for very many emotional reasons, they want to stay in their home. They raise their kids there, their doctors around the corner, their friends, all that. They want to stay in their home. So they're going to likely age in place. They're going to stay in their home until they pass away. And so what happens is, if it is a couple, and let's just say the husband passes away first, the wife is going to stay in the home until she passes away. And at that point in time, their estate is going to take care of paying us back. So whatever our balance is at the time of both of their deaths, they're going to sell their home and they're going to pay us back, and whatever is remaining, they're going to pass on to their beneficiaries as they see fit in their will.
All right. So this is not, I'm bouncing around a little bit on you here, Sean, but if they have a reverse mortgage that pays them monthly, is that monthly forever?
It's monthly until what they qualify runs out. So for example, and that's a great question, if they qualified based on their loan to value of age, location of home, and type of home, let's just say they qualified for $100,000. They can use that income, whether it be monthly, quarterly, semi-annually. Let's just say it's $1,000 a month. They can do the $1,000 a month until the $100,000 runs out. So they've qualified for 100. They're simply taking it in monthly $1,000 chunks.
I see. So just different way of cutting the
just a different way of taking the funds that they qualify for.
Now, the next question is, what if they want to sell their house?
100% can be done at any point in time. So just like any traditional mortgage product, we are simply a charge against title. So no different than any bank mortgage you would get. We're a charge on title. It's the client's home. It always is their home. They can sell it at any point in time they want. All that we need them to do is pay us back whatever the balance is if they sell their home. There is one other stipulation. So, like any other traditional mortgage product, if you pay back the funds early, there are penalties when you sell your home and pay us back early. So I'll break them down for you. In year one, the first 12 months, it's a 5% penalty if you sell your home and pay us back. In year two, it's 4%. In year three, it's 3%. Anytime after the third year, it's 3 months interest. So it becomes it's not onerous at all after 3 years. So I always say to folks, if you're going to sell your home in the first couple of years, you might want to reconsider us as an option. But if you want to still consider us as an option, just know there are penalties involved.
All right, that's good to know. Now, you also mentioned during the break there was 2 stipulations.
We have 2 requirements of people working with us and taking out a reverse mortgage. Number 1 is that you maintain your property taxes current and up to date. And number 2 is you maintain your home insurance with fire insurance coverage up to date as well. So we have that right in our contract, and that's important for us because our only security, Jeff, is the home itself. And if property taxes aren't paid, the government could take the home. So we have to ensure that our loan on that property is up to date and current.
Well, that's actually, that sounds like common sense. Now, the thing we did talk about before the break we wanted to get back to is if the market turns and the house isn't worth as much as what the home equity or the reverse mortgage is, what happens?
This, I've got an answer for you, and I'm going to sort of set it up for you because it does come up often. And we are the only provider of reverse mortgages in Canada. However, there are many providers in the U.S. No affiliation to us whatsoever, but the product exists in different variations in the U.S. Now, if you remember back to 2007, leading up to 2008, we had some major housing corrections in the U.S. So let's just say you had a reverse mortgage here and a house value here somewhere in the U.S. Within 6 months, that house value came down like this. And so now the reverse mortgage was worth more than the home itself. In the U.S., some very negative things happen. They're calling those loans. They're foreclosing on people's homes. We don't do that in Canada, and in fact, we put it right into our final contract that goes to the independent legal advice that if that event ever happened in Canada, which it hasn't, thankfully, and I hope it doesn't ever happen, but if it did in the future happen, we would take and incur any losses on that. We would never ask for somebody for more money than what they owe us. So if their house went down like this, we'll take the loss on that.
Really? So they're not going to lose their house?
They're not going to lose their house. They're not going to be foreclosed on. They're not going to have anything happen. And if they passed away with their house being valued here and the reverse mortgage here, so the reverse mortgage is more than the value of the house, we would take the loss on that. Their estate does not owe us anything more than...
Really?
Yes, correct.
That's really, really comforting.
It is comforting for our clients, yes.
Yeah, because that's a question I'm sure that comes up all the time.
I get it often. Yeah, I do get it often.
Yeah. Now, can someone use a reverse mortgage when they buy a house?
Yes, there are circumstances where we can, and I'll give you an example. I had, actually it was believe it or not, a couple in Orangeville that were looking to relocate from Orangeville to downtown Toronto because their kids and grandkids were living downtown Toronto. So they were looking to sell their Orangeville home, which was valued at about $500,000, and to purchase a condominium in downtown Toronto. Now you can probably guess that the condominium they wanted in downtown Toronto was worth more than their home in Orangeville. That's just the way the housing market is.
That's right, yes.
They still wanted to do that move. But what we did for them, we did a reverse mortgage on their new property, their new condo in Toronto. So we can indeed do what you just described, which we kind of consider a purchase, but it's a relocation to a new property.
Okay, so, I mean, that's good news for real estate agents because then they can use reverse mortgages to help with a purchase.
Absolutely.
And for someone who's moving from a house of lesser value into a property of higher value, like you said,
which is happening often now, yes.
Then those people don't have to worry about a mortgage payment.
Well, that's just it. So they're thinking the stress of, oh my goodness, how are we going to afford this condo that's $150,000 more than our home in Orangeville?
Yeah.
The reverse mortgage can help with that.
That's amazing. I mean, most people don't think that they can move from Orangeville to Toronto. They always think people are moving from Toronto to Orangeville, which is, by the way, it's a good move. If you're anywhere in Dufferin County, Bolton, anywhere around here, I think you should probably move from Toronto and come down and visit us.
There you go.
So I like the way you put all this together for us. You've been able to simplify this topic.
Thank you.
You've made me feel a lot more comfortable about reverse mortgages. So basically, reverse mortgages, they're not going to lose their home. There's no payments they have to make. They get their money today. That's wonderful.
There's no tax implications. It's,
that's
equity in your principal residence. Yeah.
That's amazing. Sean, I want to thank you very much for coming on the show.
My pleasure.
And I want to thank everyone there for viewing and coming and participating with us. And Sean, I'm blown away. Thank you very much.
Thank you very much, Jeff. I appreciate it.
Okay.
Thank you so much.